10-year note Treasury yields were lower today, and after what we saw the first week in November, that big move, that 30 basis point rally in yields, really catching many off guard as it became a lot about the Fed, a lot about China, but really it was a position shift as we saw a lot of those longs get pushed out of the market, and we saw yields get just shy of 2%. With some expectations or people expecting there to be a move above 2%. Well, we didn't get it on this move, and actually we didn't get to 2%. We came just shy of it. But now the market seems to have reversed course a little bit. Yeah, there was some headline news that probably nudged the market around a little bit. But ultimately, I think right now we're headed back into that comfort zone that the Treasury market had spent a lot of time in. That's that 165 to 185 yield range. We haven't gotten there yet, but certainly the market is very close. I think by week's end, that's where we'll be trading as more uncertainty likely looms. The same pop we saw in yields last week also brought with it a much needed jolt of volatility. We saw volatility spike to its highest in quite a long time, and right now we're seeing it back off a bit, which means the market's not really expecting another big move higher north of 2% in yield, likely one that's back towards the old range. So that takes us where we're hanging right around the 14-day moving average in 10-year note Treasury volatility. That is high. When you look at it at an outright level. However, it's off the spike high that we saw last week. Remember, that move was very fast and caught many off guard, and that's what causes volatility to push higher very quickly, obviously, not staying within the trend, not doing what it's supposed to. And last, let's look ahead. What is really the cause of what we're seeing? And it really comes down to two things. It's the China and it's the Fed. And if you look at the China news, the China-U.S. trade deal, the market has been trading off two headlines for so long, you'd wonder, when is it going to end? It's the China trade deal done, U.S.-China trade deal not done. And today we got one of those maybe it's not done deals. The stock market hasn't really overreacted to it, but we didn't see the same reaction in the bond market. The bond market did see a push lower in yield, a push higher in price on that headline. Likewise, I think as we get forward to that December NATO meeting when it's expected to get phase one of this deal in ink on paper, perhaps things will change, but I think until we get something in paper, something done, something resolute that we can hang our hats on, the market's going to continue to dance around it. When it gets good news, it's going to rally in the stocks, it's going to sell off in the bonds, and likewise the opposite when it doesn't. And I think at this point, moving forward, the Fed will play second fiddle to that headline. However, the market's not expecting any more Fed cuts this year. The market's not really expecting the Fed to do anything for quite some time. It's kind of going to be a status quo trade. If that changes, if the Fed becomes more dovish again, obviously that's going to bode to lower yields. We haven't seen that yet in the market right now, expecting the Fed to sit back and wait and watch. And certainly that's what the Fed wants to do, and it's what they're telling us they want to do. But how often does the Fed get what they want? So right now, 10-year note Treasury yields heading back into the old range, but not quite there yet. Still 2 days left to trade this week.